Good morning, everyone. Thank you so much for joining us. My name is Cassie Hopkins, and I help coordinate the webinars for Hausman Johnson Insurance and the Benefit Services Group. I'd like to welcome you to today's webinar, Understanding Builder's Risk Insurance, presented by Phil Hausman. Just a few housekeeping items. This webinar is interactive, which means that you can type in a question during our question and answer session, and Phil will address it. After the webinar is over, we're hoping you can fill out a short survey for us that gives us feedback on what you liked about the webinar, what you didn't like, and what topics you're interested in learning more about. Just an FYI that this webinar will be recorded and it will be available on the webinar archives section of our website. Each attendee will receive a follow-up email with a link to the recording as well as the presentation slides. I would now like to introduce you to our speaker, Phil Hausman. Phil joined Hausman Johnson Insurance in 2010 as a commercial agent and is a member of the Construction Industry Group. He is a graduate of Marquette University and has been immersed in the insurance industry ever since graduating. He spent the first 4 years of his career on the service side of insurance in the excess and surplus lines market. Outside of the office, Phil is an active board member on the UW Carbone Cancer's Emerging Leadership Board, as well as a board member for the March of Dimes. He also helps organize the annual YMCA golf outing. Welcome, Phil. Thank you for joining us.
Thank you, Cassie, for the very warm introduction, and thank you all for attending today's webinar. Unfortunately, I was born with a face for radio and a voice for miming, so you're going to have to bear with me here. And the whole intent of today's presentation is that the builder's risk is starting to become, I wouldn't say problematic, but it's becoming a lot more difficult for clients and contractors or owners and contractors to purchase it. And that's as a result of what's transpiring in the marketplace. In addition to that, there's also a fair amount of legwork that's going into this in regards to contractual obligations and making sure either party is appropriately covered. So before we really dive into this and get into the weeds a little bit, I want to go through today's agenda. So we're going to talk about what is builder's risk insurance, different types of coverages, what does it cover, the types of builder risk insurance policies are out there, who ultimately should purchase the coverage, some key coverage issues that both sides of the aisle, the owners and the contractors, need to be aware of, and ultimately, how's the premium determined by underwriting? So what is builder's risk? As you'll see below, the purpose of the builder's risk is a first-party coverage to protect insureds against damage and resulting loss to work in the course of construction before being delivered and accepted by the owner. Ultimately, the builder's risk policy is a risk transfer tool for those involved in the construction project. The goal of the parties to the construction contract is to transfer the risk of accidental physical damage to the work from the owner, contractor, subcontractors, and subcontractors to the builder's risk insurer. In this way, the financial resources for funding repairs are assured and the project can move forward. As the alternative to stopping the project, litigating between the parties, it's neither desirable nor practical, and it's certainly not effective because listen, both the owner and the contractor have an exposure to getting this project completed on time, whether it be financing or liquidated damages. The sole purpose of the builder's risk is to make sure that the construction project can continue to move on track. So in insurance, we're always obligated to show a picture of a giant claim and give you some perspective because no one ever thinks that this is going to happen to their project. And unfortunately, by the law of large numbers, it does. So what you're looking here is a client of mine who's had a claim. This is roughly 6 or 7 years ago in Des Moines, Iowa. You can Google it. It's the Yonkers building. This was approximately a $25 million fire, and they brought in ATF, and even with a fair amount of investigatory resources and time, they were still unable to determine the proximate cause of loss. Here's some more additional photos of the building. This is from the inside, the damage that the fire did. It was a steel concrete building and still did a fair amount of damage. And the next picture is just an aerial view. So now we know what the builder's risk is, or the intent of it at least. What does it actually cover? What it covers is the property under the course of construction and any property for the project that's stored off-site, any project or any property for the project that's in transportation. And in some cases, it can be covered, existing property can be covered, whether it be an existing building, or if there's a situation where there might be two buildings and you're trying to connect them. In addition to that, there are soft costs, which there are a fair amount of, and we'll go into a little bit deeper detail, as well as loss of rents and advanced loss of profits. So I mentioned soft costs, and really when looking at a builder's risk application and policy, they're broken down to two columns. The hard costs are really the actual cost of material and labor going into the construction project. So if someone's asking you, what are your hard costs on a project? Really ask yourself, what is the cost to replace the destroyed covered property? What's the actual building? The soft costs are really a general term for time element coverage resulting from the physical damage to the project that causes a delay. And they can include a whole host of things. And more often than not, when you're looking at a builder's risk policy, the soft costs are itemized and sublimited by line. So for an example, here's really a breakdown of what you see on the types of soft costs that are covered by insurance policies. Again, they are more often itemized one by one. However, there are some insurers out there that will say, here's your total soft cost limit. We're going to insure you at this limit, and you can, itemize it how you want. So again, soft costs more often than not include business income, any rental value, any advertising and promotional expenses, architecture and designer fees, your insurance premiums, any interest on money borrowed to finance the project, any permit inspection fees, realty taxes, and realty assessments. Okay, so what is not covered by builder's risk policy? Again, we've talked about the hard costs, cost to build the building, and the soft costs, the time element exposure as a result of a covered cause of loss. So what are the perils that are not included? Well, you have your normal property exclusions, flood, earthquake, war, nuclear explosion. And then you also have some additional perils that are excluded. So you have loss or damage from an implied or written warranty by any manufacturer or supplier, any damage as a result of rain, sleet, ice, or snow, all weather driven by wind or not, entering the interior of any property unless the building, the exterior of the property is complete. So if the building's up and you've got your windows in and it's all, for lack of a better word, fortified from the elements, then you would have coverage should something break and the elements enter the building. Lastly, and this gets we'll get into this a little bit further in the presentation, but there is an exclusion more often than not for faulty material, defects, error in design, and faulty workmanship. This is something that gets not a lot of attention when people are structuring the policy, but in the event of a loss, it's often litigated, and there's a requirement in standard AIA wording to include coverage for this. So it is standard to have a faulty material, defects, error in design, faulty workmanship exclusion in the builder's risk policy. However, if you're working with an insurer who really specializes in builder's risk and has a fair amount of experience in it, what you'll see is an ensuing loss provision. And this ultimately says we will exclude coverage for all these items, but if an ensuing loss by a covered peril happens as a result of one of these things, we will cover it. So hypothetically, someone's putting in a truss or a beam to support a building, and for whatever reason, the truss or beam were installed incorrectly and it were to break and collapse. In theory, the faulty workmanship of the installation of the beam would be excluded under the builder's risk policy, so that actual beam. But if it leads to a collapse and the roof comes in, that additional damage would be covered by the builder's risk. It's important to note that, this exclusion is probably the single most litigated exclusion in all of builder's risk insurance. So now that we've covered some of the perils that are excluded, let's talk about the property that's not covered by the builder's risk. As you'll see, land, any cost to excavate, backfill, that's all excluded under the builder's risk. And any existing property is excluded unless the policy has been amended to include existing structures. And any liquidated damages or performance guarantees are excluded from the builder's risk policy as well. So what are the different types of builder's risk policies? In truth, there are a fair amount. You have your standalone builder's risk all risk policy, and this is more or less the common policy that you as a contractor or a property developer will be purchasing. It's on a case-by-case basis, and the policy period is for the life of the project. Your insurance carrier can change with each project, as well as the scope of coverage. And it's generally, if structured appropriately, you can get some broad coverage extensions with it. On smaller projects, it's not uncommon for contractors or property developers that have a large portfolio and are doing a fair amount of small developments to have a builder's risk reporting form. Again, these are typically used for smaller projects, and the reporting is based on an agreed time frame, whether it's monthly, quarterly. The person or the party responsible for carrying the policy form or the builder's risk reporting form will report the projects as they're coming and finishing on the reporting form. The benefit of this is that it's consistent in the sense that you're locked into rates and the terms and conditions for all of your projects. And it's typically provided by your insurer, who insures your other lines of coverage, most notably your property insurance. Another type of builder's risk policy is your master builder's risk program. This is generally carried by larger GCs, and its intent is to provide coverage for a majority of a firm's projects. So roughly, underwriting looks at the past year, couple of years of projects for a general contractor, and get a sense of the work that's being performed, and they tailor the program to encompass about 80% of their exposure. Again, it's consistent policy conditions. It's written on an annual basis, and there's a benefit, again, to have a locked-in rate. A couple other ones that are not necessarily builder's risk policies, but there is an element to builder's risk coverage, is that a difference in conditions policy. This is most often purchased to obtain coverage for flood and earthquake when one party is purchasing a builder's risk policy and it's not providing that coverage. It's also sometimes, and this is more rare, used to cover collapse, including resulting time elements. So sometimes there'll be a project where collapse will be excluded under a property insurance policy specifically. So when someone's not using a builder's risk policy and they're relying on their own existing property policy, That policy may not provide coverage for collapse while construction is taking place on the property itself. So either the project owner or the contractor will purchase this differences in conditions policy. As I just mentioned, there are times where one will use their existing property policy. It's really intended for small incidental construction projects, and it's limited in its policy conditions for construction. So it's not something you really want to rely on. And if someone is relying on it, you certainly want to go through the steps to vet the appropriate coverages in place. Then lastly is the installation floater. This is a little bit different because it only covers one insured, the party that has the installation floater, and it's commonly written for repair or refurbishing of structures. It does not provide coverage for collapse. So in the event that you're moving or someone's moving load-bearing walls and they're relying on their installation floater, that's a problem. Ultimately, what the installation floater covers is any material that has been yet to be permanently installed into its final resting place, for lack of a better word. So if someone's installing, doing a bathroom renovation and they have a bunch of sinks and those sinks are damaged in the course of transportation or while on the job site, or they're stolen, that's covered under the installation floater of the contractor, so long as the contractor purchased them. So who should be purchasing the insurance? Well, standard AIA and DBIA contract language calls for the owner to purchase it, while the EJCDC and the consensus docs call for the contractor. However, what they don't all specify is not only who should purchase it, but who is responsible for the deductible and what is the deductible. Under the AIA and DBAIA forms, the owner is responsible for the applicable deductibles. However, there is no set requirement. The AIA form further requires the owner to be responsible for self-insured retentions as well. The consensus doc form places the responsibility for deductibles and any co-insurance payments on the party that is the primary cause of a claim. If no party is the primary cause of the claim, the party obtaining the builder's risk policy is responsible. And lastly, the EJCDC form places the responsibility of deductibles on the purchaser of the builder's risk property insurance. Again, while they're allocating who is purchasing the policy and who is responsible for the deductible, they do not mention what the deductible is. So make sure when you're going through this, all parties are aware, because that it can be a substantial cost should an event take place. So now we know who's obligated to carry the policy. Why would you want to carry it? Or why do you want to make an argument that you should be carrying it? The benefits to carrying the policy are that you are the first named insured. With that becomes some coverage grants, if for lack of a better word. You are able to file a claim. You will be receiving the proceeds of any claim settlement, and that carries some weight, because there is an instance, or there are instances when the one party of a builder's risk policy may not want to file a claim and the other party does. There's also the certainty of coverage. You are putting the policy in place. You are putting the final read through of the coverage proposal and limits before binding coverage. You do again have control of the claim, and you have advantageous terms and conditions in the sense that you know what the coverage is in place. You know you're making the final choice on whether you want to self-insure a risk or not. So we're just going to look at the AIA wording here, because that's truthfully what we see most often than not with construction contracts. I've highlighted or underlined some key statements. Because the first one, it reads, This insurance shall include the interest of the owner, contractors, subcontractors, and subcontractors in the project as insureds. This insurance shall include the interest of mortgagees as lost payees. That first line there is very important because whoever's purchasing the policy, they're covered. And this obligation makes sure that the policy that's being purchased is covering all the other parties that are involved in this construction project, because they all carry a fiduciary interest in the project until it's completed. The second line, the causes of loss, is important because it specifies standard wording that you have to include some coverages that are not normally automatically included under a builder's risk policy. So for instance, you'll see that they're specifying that earthquake and flood both need to be insured for. Well, with that comes an additional cost. And it's not uncommon for folks to either strike these requirements, which before, it's not a big deal, so long as everyone's aware of it. But sometimes they don't, and then they purchase the builder's risk policy, and in an effort to control its cost, do not include those perils, which ultimately puts them in breach of contracts, which comes with its own issues. Below the final line is something that we spoke about earlier, and it reads, this insurance shall also provide coverage for ensuing loss or resulting damage from air emission or deficiency in construction methods, designs, specifications, workmanship, or materials. And this goes back into what we spoke about earlier in the presentation, the ensuing loss provision. And not every single insurance policy out there provides this. So in the event something were to occur, not only is the person purchasing the builder's risk policy potentially in breach of contract, they're also putting themselves and every other party of the contract in jeopardy to getting this thing back up and running in a timely manner. This, again, I can't stress the importance to make sure that when you put a builder's risk policy in place, that there is an ensuing loss provision. So what are some key coverage issues that we run into? And as I think I said at the beginning of the presentation, we are getting more and more questions, and I don't want to say issues, but for lack of a better word, issues with builder's risk, because people are becoming more and more educated about it. And so to make sure that things are going smooth and normal, or smooth and steady, I should say, it's important that we address some of these key coverage issues. The first being insured parties. How are we going to be naming the appropriate parties so that we know everyone's interests are protected accurately? So the best way to go about it is making sure that all the parties are named insured to the policy. More often than not, they will allow the owner or the contractor certainly to be the named insured. That's whoever's purchasing the policy. Then ideally, the other primary party will be named as named insured as well. Below are a couple examples of how policies read as additional named insureds. For instance, to the extent required by contract for the insured project, and then only as their respective interests may appear, owners, contractors, subcontractors, and other individuals or entities specified in such contract shall be recognized as an additional insureds hereunder, but limited only to their activities as a project location. That is some verbiage that is common, and while it's not preferred, because you never really want to say it's limited only to your activities at the project location, or only as respective as their interests may appear, because it can lend itself to potential subrogation issues. More and more case laws proving against that concern. So it's not necessarily something to be concerned with now. However, certainly the next two language or references or where you would prefer to be covered, and that is all above herein referred to as the insured, or the named insured shall be deemed the sole and irrevocable agent of each and every insured for sending and receiving notices, giving instructions, and making and receiving payments, etc. So what that's saying is the first named insured is going to be having the rights of the first named insured, but everybody else is still considered an insured. If that makes sense, it is a little confusing. So it is important to note that the EJCDC is the only one of the 4 major standardized construction contracts to require that designated parties be included as named insureds under the builder's risk policy. And the name insured, again, is preferred because it gives the project owners, contractors, and subcontractors equal coverage and equal standing under one policy. Second, the named insured status should provide the contractors and subcontractors with protection from subrogation. And just so everyone's aware, I've said that a couple times, subrogation is the legal action taken by the insured to recover amounts paid for a covered cause of loss from the party who caused it, in the event that there is a covered cause of loss. Naming the contractors and subcontractors as insureds provides protection against subrogation, because the general principle is that an insurer, insurance company, cannot subrogate against its own insured. In that first example, again, it states in the interest or, limited to the activities of that project location. In policy language that states such as that does not cover the party appropriately, and it does not provide the same level of protection for the subcontractors, contractors, as named insured status, because it does not provide immunity from subrogation that applies to contractors and subcontractors who are actually named insureds. Lastly, and this is more common, again, with existing property policies, but it's certainly not something anyone wants to accept, is the loss payee provision. So if you're being named as a loss payee, you're really kind of handcuffing yourself from anything, because if the named insured on that policy doesn't make a claim, the loss payee certainly can't make a claim. And without being named as an additional insured or co-insured, the loss payee is exposed to subrogation action by the insurer if its acts or omissions cause the damage to the work. It is not uncommon for someone or an insurer to name somebody as a loss payee, particularly on an existing property policy. And there will always be some pushback, because the property insurer does not necessarily want to name another party a named insured on a property policy, because it's a fair amount of coverage that's being afforded. That being said, there is a contractual obligation, so long as it's not been amended, in all the standardized contracts requiring that they must do so. So if and when you're getting pushback, we've been more than happy to assist our clients in going through this process and kind of coming to an ultimate remedy and getting the coverage or their interests appropriately covered. Continuing the builder's risk key coverage issues, we spoke a little bit about it, but primarily cat perils are the largest concern in terms of the flood and earthquake. Are they responsible for carrying it, and are they carrying it? A couple other coverage issues that are always out there are the debris removal, demolition and increased cost of construction. What's the exposure for property that's in transit or stored off site? Expediting and extra expense, contractor's extra expense, any interruption for service to try and get the project back up and running in the event of a loss, hot and cold testing. So what is hot and cold testing? Cold testing is really easy to explain. It's really the startup and testing of building systems when you get back up and running. Hot testing is geared much more for the manufacturing exposure, and it's any startup or commissioning of other forms of testing, making use of any feedstock or similar media, including operation and performance tests. The vast majority of building that's taking place in Madison and the surrounding area is residential building. So hot testing is not as large a concern. However, if you're building a manufacturing plant or a really significantly power plant, things of that nature, hot testing is a real big issue that needs to be appropriately addressed. And all these things are listed as coverage issues because it's not uncommon for folks not to really take a deep dive and think about what the actual exposure is, because a lot of these there's some boilerplate coverage that is given. But if you're building a $10 million building, I'm telling you right now, you can't rely on it because you're going to be underinsured. So unless someone's having these conversations, it can lead to a real problematic scenario. And we have, builders risk claims, unfortunately, every single year. And it's not because we work with bad developers or bad contractors. It's the law of large numbers, and things happen. And so fortunately, we've worked through enough claim scenarios where I know where there's some issues, and these are the ones where we're seeing a fair amount of it. That Yonkers building that I started at the beginning of the presentation, they had a debris removal limit of about $2 million. And they were getting close to hitting it because the landfill could no longer, or the closest landfill, could no longer accept any more debris. So they then had to ship it to other landfills, and that took cost more money because they're driving farther. And it got close to the point of exhausting the limit. Fortunately, it didn't. So another big coverage issue is, when does the builder's risk policy end? So the period of insurance starts from when you purchase the policy to the estimated completion date. So up above, you'll see we have a 2-year scenario. This policy will provide coverage until that expiration date, unless one of the following happens before that. And that is the formal acceptance by the project owner, when the interest of the named insured ceases, when the insured project is occupied for its intended purpose, and when the named insured abandons the construction with no intention to complete it, or again, when the policy expires or cancels. One thing that we want to talk about is that third bullet point, when the insured project is occupied for its intended purpose. This leads to some problematic scenarios because, as I mentioned earlier, there's a fair amount of residential construction taking place in Madison and all over the state, all over the country. And it's not uncommon for project owners to start looking to move people in to completed portions of a building while the rest of the building is finishing up. So in order to ensure that the builder's risk policy is still in place and covering all the necessary parties, we want to make sure that there's a permission to occupy endorsement on the builder's risk policy. And there's several ways to do it. And every insurance company does it differently, and there's ways to amend it, but really it's broken down to 3 ways. It's the whole or in part, and that is, are you putting it to its intended use or not? And then the occupancy clauses are either based on square footage or a time period. More often than not, the time period is the preferred way to go, because if you're building on an apartment building, hypothetically, and you've got 60 days left or 90 days left doing punch list items, a couple other things, turning on water or whatnot on additional floors, You have everyone moved in. This gives you, your deadline, so to speak. The square footage can be problematic, particularly in residential, because those numbers change quickly. The occupancy clause for square footage is more common in, again, the manufacturing world where they're occupying a certain percentage of the plant while the other plant is completed. Other side of the plant is completed. Last but not least, in terms of the coverage issues, is the waiver of subrogation. Again, we're looking at standard AIA wording, but all 4 standard construction contracts carry a waiver of subrogation provision. And again, just as a reminder, the waiver of subrogation prevents an insurer from going or suing a party responsible for a cause of loss. This is a very important provision because it gets to the whole intent and concept of the builder's risk policy, and that it is the sole remedy in the event there's a loss on a project. And there's oftentimes there are folks who will look to strike this coverage provision. And for the life of me, it's really difficult to understand why. Because if you're trying to speak to the intent of the policy, exposing either party doesn't do anyone any good. So when you're going through this provision, or when you're going through this process, you want to ensure that the waiver of subrogation provision is in line and has not been removed. And then you ultimately want to seek an evidence of property insurance that's indicating all the coverages that have been agreed upon via the insurance contract, or the construction contract, I'm sorry. And this is a step not everyone adheres to, and if and when a loss occurs and it's difficult, this really changes, the light bulb switches on and they start collecting these things at a much more, with much more fever, if you will. They understand the importance of it. So when you're looking at evidence of property insurance, you want to make sure that the insurance company and carrier information is here, and you want to see the effective date. And then ultimately you want to make sure that the building ownership entity or the contractor are listed as the named insured, and they identify project location and its address. Pretty simple stuff. Then where we get into the meat and potatoes of it is the coverage information. If they're using a builder's risk policy, you want to make sure the builder's risk limit specified for its completed value under the amount of insurance. And then you want to make note of the deductible, make sure you're aware of what it is. And in the event that someone's using their existing property insurance policy, you want to make sure you know the building limit, and then the property in the course of construction limit meets or exceeds the restoration value. You'll also want to ensure that it's written on a special form and a replacement cost basis with agreed amount. But that's really, again, only if you're looking for an existing property policy. The real area you want to put, or I shouldn't say the real, the additional area you want to look into is the remarks, because you want to know, and I put it in parentheses here, it's the party not purchasing the builder's risk policy, so whether it be contractor or owners, that party and all subcontractors and all subcontractors are listed as an additional named insured. You want to make sure the waiver of subrogation applies in favor of the parties that were mentioned with respect to the property or builder's risk insurance. This is your safety net to make sure that the policy in place is reflecting the coverage that is being required by the contract. Ideally, you want to receive these prior to beginning work on the building. However, we understand how things go, but it certainly is something you guys want to take into consideration when you're building out your processes and procedures for a new project. Lastly, on the bottom, you'll see that you want both the additional insured and waiver of subrogation box checked as well. The reason why we have that and the remarks, it's kind of a belt and suspenders look, because the additional interest will typically say you, the person who's receiving the certificate. Well, the contractual obligation of the contract requires far more than that to be listed as named insureds. So how is the premium determined? And for those that are in the building or purchasing builder's risk, it's no secret that the costs have gone up substantially. And that's more so in the frame construction than anything else. But what's done is how the premium is calculated is that it's a simple math equation. They look at the hard cost, and you assign a rate for the hard cost construction costs, and it's really per $100 of the construction costs. And the same goes for the soft costs, or business income, or delay in insurance premium. As I mentioned, frame construction rates are going considerably higher. A lot of that is due to a fair amount of claim activity due to the social unrest that took place this previous summer. If you think about it, buildings under the course of, frame buildings under the course of construction and vacant buildings, they take in a fair amount of damage because they're not certainly as protected or policed as well as existing property structures. The non-frame construction still is a relatively competitive market in the sense that it hasn't nearly doubled like frame construction. In flood and earthquake insurance, they are rated a little bit differently based on location of the project. The other thing that's starting to really drive costs of builder's risk insurance is how are you protecting job site security. So in order to get the rates that are assigned to the hard and soft costs, you want to get an application completed. Here's the application a lot of our clients complete, and you want to be as detailed as possible. In addition to the application, you'll want a site plan, the construction timeline, and then the site security. And I mentioned site security because it's not just the standard, oh, we have a fence up now. Any project really over $10 million, there's a little wiggle room there for frame construction, is going to need to have a significant security measures implemented. And those sometimes are required by the insurance company. And not only are they required, but if you do not enact them and there's a covered cause of loss, you put yourself in jeopardy of not having coverage. And they might even require that you go through one of their approved vendors. So, and this is becoming really difficult waters to navigate because it's so new and it's moving relatively quickly. So when you're submitting an application, you'll certainly need to, for any project, want to have site perimeter fencing, fire extinguishers, and then on projects of, let's say, $15 million and more on frame construction, you'll want to have either on-site watch service or video surveillance and monitoring. And the key word there is the monitoring, because a lot of folks put up security cameras, but there's not 24/7 monitoring attached to it. There are some loopholes for contractors and owners to consider. If you use Arlo cameras and you get notifications, they consider that monitoring, or some insurance carriers will. Some of the other things that are being required are water flow and fire alarms on each floor of the building, as well as a hot works program and a water mitigation plan. All those things sometimes are going to be needed for a submission to get an appropriate builder's risk proposal. That concludes the builder's risk presentation. I appreciate you all sticking with me as I stumbled through it, and I hope it was impactful. At this point, if there's any questions, by all means, feel free to ask away.
Yeah, thank you, Phil. So if anyone has any questions, you can type them into the question feature or the chat feature. It's up to you which one you'd like to use. And we'll just hang out here for a second and see if anything comes in.
I will also say if there's, feel free to email me or call with any questions as well. It is a fair amount of information, and you really can go into the weeds, much like any insurance product. But I hope gave you some oversight and at least something for you guys with a walk away of maybe we should be doing this, something that we should be keeping an eye out for. So thanks again.
All right, we got a comment from someone saying you did a great job. So good feedback.
Oh, thank you. You're being too kind.
All right, it looks like there are no questions at this time. So again, you guys can always email or call Phil. His contact information will go out in the email that we'll send out to all the attendees. We'd love if you could take our survey and give us some feedback on what you thought, as well as future webinar ideas. And with that being said, I hope you all have a wonderful rest of your morning. And thank you again to Phil for putting on a great webinar.